Asia is home to half of the world's population. With a large rising middle class, it will continue to be one of the fastest growing regions, providing plenty of investment opportunities and diversification for investors. As the biggest global growth engine, Asia contributes to 2/3 of global growth, led by China and India. Earnings growth is also expected to be strong at 20% in 2024, but we become more selective in our positioning. This inflation also provides room for some central banks to cut rates ahead of the West. Looking ahead, focusing on China alone for Asia exposure is not enough. There's the need for China plus AI. And AI in this case is not artificial intelligence, but ASEAN and India. And they offer great growth opportunities. Well, India stands as one of the most exciting structural growth stories in Asia. It's supported by young demographics, booming digital economy, strong foreign direct investments, as well as benefiting from the trend of global supply chains diversification. India is moving up the value chain with higher value-added services, particularly in the professional services. And of course, recently what we've seen is an improvement in their ability to manufacture goods. In the next few years, we're going to see about a quarter of iPhones that will be assembled in India. Service exports is also extremely strong. At a fraction of the cost, India will continue to capture global IT share. And last year, India's service exports increased by fivefold, and this should continue strongly into 2024. So we like large cap companies in India, selected banks, consumer discretionary, and the IT companies in India. We also like India's local currency bonds because of its higher attractive yield and its growth prospect, but also with the inclusion into global EM bond indices. Well, we also like ASEAN, which is similar to India, enjoys a large domestic economy, and also it benefits from investments from both foreign direct investments as well as private investments. And one of the markets in ASEAN we like is Indonesia. Indonesia has the world's largest nickel deposits and stands to benefit from the entire electric vehicle battery manufacturing complex. In North Asia, we like Korea because Korea stands to benefit from the tech cycle upswing, as Korea is a major manufacturer of memory chips, and we think that Korean market can actually benefit from this recovery in the tech cycle. China is facing slower growth due to its weak property market. Having said that, we should see proactive government support in terms of fiscal and monetary easing that will support the economy to deliver solid growth in 2024. In fact, a lot of the negative news are already priced in. While we remain selective on Chinese equities, we see pockets of structural opportunities in the internet, service consumption, travel, and Macau gaming sectors in which select e-commerce leaders in consumer discretionary stocks can still do well. While 2024, Taiwan, Korea, Indonesia, India going for elections, and in the second half of the year, you're going to have the US elections in November. All these are big events that could rattle and create market volatility. However, I think it's important that investors stay invested in markets throughout the year because growth, inflation, and interest rates will be the bigger driver. And these drivers are actually moving in the right direction. Earnings growth is strong, inflation is falling, and interest rates should actually fall. However, if we do get certain risk events, which is not our base case, such as the resurgence of inflation, central banks would have to tighten interest rates faster than expected. That would slow the economy down, and that could actually rattle markets. However, that's why I think it's important for investors to look at quality assets such as highly rated bonds or large cap stocks to provide that stability in their portfolios.